This conference will now be recorded.
Hey everybody, I am Kevin Clark. I'm the CEO and the co-founder of Plant Confidence Corporation. Our goal here is pretty simple. We want to help the 100 million Americans that are investing in their workplace retirement plans by receiving ongoing professional advice from an advisor you're choosing. So let me turn on the screen sharing here and jump into our February 2023 market review and talk about that and where we think the market is heading going into the month of March. All right, so we should be sharing at this point. Today I'm going to put my investment advisor hat on, which I've been an investment advisor since 1997, and we're going to talk about the current state of the financial markets. We don't need the audio on that. So here is the February market review. But first, legal disclosures. Here's what the lawyers make us say. Nothing's going to be tax, legal, financial advice. Talk your own financial advice about personal situation, blah, blah, blah. Have any questions, comments, or compliments, especially the compliments, send them to Kevin at planconfidence.com. Okay, legal duties are over. So let's take a look at what happened in February 2023. So the market returns for year to date for 2023. Dow Jones is just 30 large U.S. companies. It's down 1.67% year to date. The S&P 500, which is 500 U.S. large, medium, small U.S. companies, is up about 2.84% year to date. And the technology-laden NASDAQ, which was last year's worst performer, is up 8.67% in the first 2 months of the year here. And if we take a look at Pimco total return for a proxy on the bond market, which most 401k plans have in there, that's up just under 1% year to date. And according to Morningstar, the S&P 500 was actually down 2% for the last 4 weeks. And again, the S&P 500 is 500 U.S. companies out of about the 4,200 or so that make up the U.S. market. It's a much better gauge and overall health of the financial markets than the Dow Jones, because the Dow Jones is only 30 stocks. But the news is going to focus on the Dow because it changes more rapidly, has much larger swings up and down, and it's more sexy to talk about. But one thing that I notice when I look at this chart is the big losers of this year were last year's winners. Utilities, commodities, precious metals, equity energy. Equity energy was last year's biggest winner, up over 50%. They're all down right now for the first 2 months of the year. And especially energy, that's very surprising. And the big winners year to date were last year's dogs. Tech is up over 11% or so. Consumer cyclical up over 10%. Small mid growth are doing really well. Growth style investing was dramatically out of favor last year. Last year, growth style investors got absolutely crushed by the markets. Here's a market barometer. This is what we use from Morningstar. Nerds like me like to watch what style of investing is currently working. You can see over the past year, growth was struggling and value style actually hardly lost any money. And at the end of last year, growth was actually down about 38%. But check this out. This is the year-to-date market barometer. What? This is fascinating to nerds like me. Growth style investing has been dramatically in favor since January 2nd when the markets opened for 2023. Small cap stocks are far outperforming as investors are putting more and more money into riskier assets. This is a complete reversal from last year. But wait, let's not bet the farm yet. Stocks are currently under dramatic pressure due to rising bond yields. The one-year treasury is up over 5%. We're actually seeing investors start to question why they should even risk any money in stocks right now when they could get a 5% guarantee from the United States government just to park their money there for the next year. But before you move all your money into bonds, just know that the Federal Open Market Committee, or the FOMC, or better known as the Fed, are here to ruin your day. Jerome Powell, the head of the Fed, said that he is hell-bent on taming inflation. So far, he's done a terrible job. One of the only tools that he has right now is to continuously raise interest rate. He needs, for lack of a better term, to damage our economy. He needs to slow it down. So he keeps raising interest rates, making virtually all non-fixed debt more expensive every 6 weeks, every time they meet. And when he does this, he's actually driving bond prices down. As interest rates go up, bond prices come down. So you may not want to pile a bunch of money into the bond market right now, as if they keep raising interest rates, we know long-term bonds are absolutely guaranteed to lose value. And Jerome Powell of the Fed is causing short-term problems for the stock market. Now, this is an extremely nerdy chart that I review every single morning before the stock market opens. The yellow circle on here is the S&P 500 in relation to its 50-day and 200-day moving average. Long story short, when it goes below either of these averages, it's technically bad. We're currently below the 50-day, and soon we're going to be below the 200-day if the markets don't change direction. The red circle is the moving average convergence divergence lines, also known as the MACD. And the MACD measures current momentum in the markets. And in my professional opinion, it's absolutely the best indicator of the direction of the market. You want to see the black line above the red line. In this case, the red line is above the black line. This is one of the main reasons that our tactical models, they're in 50% of their equity holdings, are sitting in cash right now. And now for the bonds, or specifically Pimco total return, it's not looking that much better. This is the 50-200-day moving average. We see that it's bad. It's below both. And the MACD is heading in the wrong direction because the red line is above the black line. All right. So that's my take so far on where the markets were and where they're absolutely heading. The moral of the story is you need to have a plan, my friends. Volatility is here to stay for a little while. We know that because of the MACD, 50-day, 200-day moving averages, plus the VIX is still above 20. But know that you could profit from volatility if you have a plan. And if you're using Plan Confidence for your ongoing professional advice, and you absolutely should have received instructions yesterday, the first trading day of the new month, on how to adjust your future contributions or the money that's going into your plan with each and every paycheck as we're trying to profit from the current volatility. And if you're using Plan Confidence, I do sincerely thank you for choosing us for your ongoing professional advice. Now, if you have any questions, compliments, or anything, send them to me at kevin@planconfidence.com. Otherwise, have an awesome March. Stay confident, my friends. And as always, peace. Let me figure out how to turn this off.